Hello everyone. It's day 49 and today I have the Hindu newspaper because it's Sunday and on Sunday's newspaper edition, Indian Express edition, there is no important article, but there are few important article in the Hindu newspaper on the page number frequently asked question and science page, but the most important article are on the frequently asked question. There are two articles which I found to be important. One is about the green credit program rules and other is about the outlook on the global economy. So we'll try to cover both of these articles one by one. So let us see what are the new green credit program rules says. So who will carry out afforestation measures? What will states need to do? Can companies trade green credits? So let us see. On April 12, the Environment Ministry issued further guidelines on its green credit program 2 months after it had prescribed rules governing the first initiative, afforestation. Modifying the rules, an official said will prioritize the restoration of ecosystem over mere planting of trees. Okay. So what is green credit program? This program was officially unveiled in October 2023 and has its provenance in mission life, a principle frequently articulated by Prime Minister Narendra Modi. Its goal is to lay an emphasis on sustainability, reduce waste, and improve the natural environment. The GCP, that is Green Credit Program, GCP program present itself as an innovative market-based mechanism to incentivize voluntary actions for environmental conservation, according to a document of the Environment Ministry. Under this, individuals, organizations, and companies, public and private, would be encouraged to invest in sectors ranging from afforestation, water conservation, stemming air pollution, waste management, mangrove conservation, and in return be eligible to receive green credits. And autonomous body of the ministry, the Indian Council of Forestry Research and Education, is in charge of administering the program. They will define methodologies to calculate green credits that results from activities prescribed. They will also manage trading platform whereby such credits could be traded. In February, the ministry prescribed the rules governing the first of these initiatives, afforestation. Broadly, companies, organizations, and individuals could offer pay for afforestation projects in specific tracts of degraded forest and wasteland. It said the actual tree planting would be carried out by the state forest departments 2 years after planting and following an evaluation by the ICFRE. Each such planted tree could be worth one green credit. So far, the Hindu has learned that forest departments of 13 states have offered 387 land parcels of degraded forest land worth nearly 10,983 hectares. Those who are successful in fulfilling the criteria will be given an estimate of the cost involved in the afforestation. Public sector companies such as Indian Oil, Power Grid Corporation of India, the National Thermal Power Corporation, Oil India, Coal India, National Hydropower Corporation have reportedly registered to invest in the program, a ministry official confirmed. So why has the GCP stoked controversy? The GCP, the GCP has not become operational, but critics have questioned multiple aspects of it. The first is that it makes a commodity out of environmental conservation. India's forest conservation laws oblige any industry that is allowed to raise forest and use that land for non-forestry purposes to provide an equivalent amount of non-forest land to forest authorities and pay them to afforest that land. The GCP program for afforestation says that companies can exchange their credits for complying with the compensatory afforestation. This could be a way, critics say, to ease forest diversion requirement for mining and infrastructure companies. Secondly, planting trees does not automatically boost ecosystem. India has about 200 types of forest. Some are grassland, some are dominated by shrubs, and there have been studies to show that planting the wrong type of trees could foster invasive species or prevent a sustainable ecosystem. There is also a threat that natural forest could be raised and invasive monocultures promoted. Finally, the GCP also says that the green credits that result in storing carbon from trees may be used for carbon trading. This again is controversial as the math equating these activities is not clear. So, how has the government responded? In its latest update, Ministry has issued the guidelines that states must rely on to calculate what it would cost to restore a degraded forest landscape. The ministry has tweaked an earlier requirement that there be a minimum of 1100 trees per hectare to qualify as a reforested landscape and left it to states to specify them. Not all degraded forest can support that kind of density. Thus, in some places, shrubs, herbs, and grasses may be suitable for restoring the ecosystem, Namita Prasad, Joint Secretary in the Environment Ministry, told The Hindu. Preference would be given to indigenous species. The program was currently in a pilot project mode, and questions such as how shrubs and grasses could be quantified in terms of green credits were still being worked out, she added. Moreover, companies would not be able to offset all their obligations under compensatory afforestation using green credits, but could claim a portion of it, she clarified. So that was about the green. What is that? Green GCP. That is a green credit program. So one important article about the outlook of the global economy. So let us see quickly what this article is saying. So what are the risks and vulnerabilities the International Monetary Fund has warned about in its latest financial stability report? It is the threat of global recession warning waning. Is the American economy doing well? Will it have a spillover effect on emerging markets? So let us see the story so far. The International Monetary Fund released the latest global financial stability report on Tuesday, warning about the risk to the global financial system that from persistent high inflation, rising lending in the unregulated credit market, and increasing cyber attacks on financial institutions. So, what is the IMF's worry about inflation? The IMF has flagged rising enthusiasm among the investor that the fight against high inflation over the last few years has almost come to an end. Investors have been pushing up the prices of the financial assets such as the stocks in recent months in the hope that central banks will soon begin lowering interest rate as inflation comes under control. It should be noted that central banks generally try to lower interest rate by injecting more into the economy when inflation falls in an attempt to boost economic growth. Although central banks are yet to lower investors may take falling inflation as a cue that central banks will soon flush the market with more money to lower interest rates, so they go ahead and purchase financial assets in anticipation of greater demand for these assets when banks actually lower interest rates, thus pushing up the prices of these assets right now. The IMF, however, believes that investor enthusiasm about slowing inflation and a possible cut in interest rates by a central bank may be quite premature. It has noted that the fall in inflation has probably stalled in some major advanced and emerging economies where core inflation in the most recent 3 months have been higher than in the previous 3 months. The IMF has also warned that geopolitical risk, such as the ongoing war in West Asia and Ukraine, could affect aggregate supply and lead to higher prices. Thus, it believes might stop central banks from lowering rates anytime soon. If these risks persist, the IMF believes investors who have been bidding up asset prices, expecting fresh money from central banks to push up asset prices in the near future, may change their mind. This could this could cause a sharp correction in the prices of various assets and leave many investors with significant losses. So, what does it mean for India? The IMF notes that fund flows into emerging markets have been strong till now due to optimism over central banks easing interest rates. In fact, in calendar year 2023, India was the second largest recipient of foreign capital after the US, according to the Elara Capital. But things could change quickly if Western central banks signals that they could keep interest rate high for a long time. This could cause investors to pull money out of the emerging markets like India and increase pressure on their currencies. The Indian rupee has already been depreciating and traded at a new low of 83.57 against the US dollar last week despite likely intervention by the Reserve Bank of India. A severe outflow of capital if Western central banks fail to lower interest rates could cause further depreciation of the rupee and have effects on the country's financial system. In such a scenario, the RBI is likely to defend the rupee by curbing liquidity to raise interest rates, which could cause the economy to slow down. What about the private credit market? The IMF in its report also noted that the growing unregulated private credit market, in which non bank financial institutions lend to corporate borrowers, is a growing concern as the troubles in the market might affect the broader financial system in the future. It estimates that the private credit market globally grew to $2.1 trillion last year, The non bank financial institutions lending to corporate borrowers include institutional investors such as the pension funds and insurance companies. Institutional investors are investing in the private credit market because they offer higher returns than normal investments. Meanwhile, the borrowers benefit as they cannot get convenient long-term funds through other venues. The IMF, however, is worried that the borrowers in the private credit market may not be financially sound and noted that many of them do not have current earnings that exceed even their interest cost. It also argues that since these loans rarely trade in an open, liquid market like many other securities do, it might be hard for the investors to really gauge the risk involved in these loans. Thus, thus, private credit assets have significantly smaller markdowns in their mark to market value during times of stress, the IMF notes. In a highly liquid market where securities are traded frequently, the real risk behind a loan is priced in more immediately and also more accurately by investors. Nevertheless, it may be the case that institutional investors are fully willing to bear the risk in return for higher returns. India has also seen the growth of small private credit market with the rise of alternative investment funds. These funds lend money to high risk borrowers who are not catered to by a traditional banking system and non-banking financial companies. They have also invested in distressed assets that have come up for sale under the insolvency and bankruptcy code regime. The Securities and Exchange Board of India notes that investments made through these funds, although still small, have has more than tripled from rupee 1.1 lakh crore in 2018-19 to rupees 3.4 lakh crore in 2022-23. As financial regulators, both the RBI and SEBI has been noticing this trend and tried to increase scrutiny over these funds. So these were two important articles that I find over the Hindu page, the Hindu newspaper. One important article that I would like to read is from the science page, which is regarding the heart failure is the common complication of the atrial fibrillation. So let us see what this article is saying. So the lifetime risk of a atrial fibrillation, a heart condition that causes an irregular and often abnormally fast heart rate, has increased from 1 in 4 to 1 in 3 over the past 2 decades, as per the study published in the BJM. Among those with the condition, 2 in 5 are likely to develop heart failure over their remaining lifetime, and 1 in 5 encounters a stroke with little or no improvement in the risk evident over the 20-year study period. Once atrial fibrillation develops, patient care has primarily focused on the risk of stroke, but other complications such as heart failure and the heart attack have yet to be fully explored. To address this knowledge gap, researchers analyzed national data for 3.5 million Danish adults with no history of atrial fibrillation at the age 45 or older to see whether they develop atrial fibrillation over a 23-year period or not. So, lifetime risk, all 3,62,721 individuals have a new diagnosis of atrial fibrillation during this time. 46% women and 54% men, but with no complications, were subsequently followed until a diagnosis of heart failure, stroke, or heart attack. The results show that the lifetime risk of atrial fibrillation increased from 24% in 2000 to 2010 to 31% in 2011 to 22. The increase was larger among men and individuals with a history of heart failure, heart attack, stroke, diabetes, and chronic kidney disease. Among those with the atrial fibrillation, the most common complications was heart failure. Lifetime risk 41%. This was twice as large as the lifetime risk of any stroke 21% and 4 times greater than the lifetime risk of heart attack. Men showed a higher lifetime risk of complications after atrial fibrillation compared with the women for heart failure, that is 44% versus 33%, and heart attack 12% versus 10%, while the lifetime risk of stroke after atrial fibrillation was slightly lower in men and than women, that is 21 to 23%. Over the 23-year study period, there was virtually no improvement in the lifetime risk of heart failure after atrial fibrillation, that is 43% in 2000 to 2010 versus 42% in 2011 to 22, and only slight 4.4 to 5% decrease in the lifetime risk of uh, any stroke, ischemic stroke, and heart attack after atrial fibrillation, which were similar among men and women. This is an observational study So no firm conclusion can be drawn about cause and effect. So that's all from today's newspaper. We'll meet again with a few important article on Monday. So till then,